For nearly 2 decades, these two lines were moved in unison until something broke right here. The black line is the S&P 500. And as that has gone up and down, so too has this other line, job openings. It made perfect sense. When companies grew, they hired more people. But in 2022, that relationship broke down. Since then, the S&P 500 has soared by over 70%, while job openings have fallen by around 30%. This gap shows two completely different stories. One where investors are celebrating a new golden age, and another where the real economy is shrinking. Most people would look at this chart and blame artificial intelligence, and that's because ChatGPT came out right here in November 2022, right around when these two lines began diverging. So, at face value, this chart seems to indicate that our biggest fears about AI taking all of our jobs are already becoming reality. But there is a massive hole in that theory, and it has to do with timing. If we look closer, labor demand peaked and began its free fall in March 2022, 8 months before the release of ChatGPT. The decline in job openings didn't start with the surge of artificial intelligence. It actually started with the Federal Reserve. The culprit becomes obvious when you overlay the federal funds rate. You can see that right at the peak of the job market in Q1 2022, the Fed began the fastest interest rate hiking cycle in decades. They raised the rate from the near zero post-pandemic lows all the way up to over 5% by August 2023. They did this to tamp down on runaway inflation, which had gotten totally out of hand after all the economic stimulus meant to revive an ailing economy during the pandemic. Inflation reached 9.5% by summer 2022, and the Fed intervention worked. Inflation began to fall immediately, and the economy cooled off. And this explains why job openings began to fall in March of 2022. When rates go up, borrowing gets expensive. Companies stop expanding. They pull down job postings. Therefore, this crash in job openings isn't a disaster. It's exactly what the Fed expected to happen when they hiked rates. Since the Fed began hiking rates in spring of 2022, job openings declined from a peak of 11.5 million down to about 7 million today. In many ways, this is a stealth win for the Fed. They deflated a bubble without causing mass unemployment yet. However, unemployment has ticked up since 2022 as well, from a low of around 3.3% in April of 2023 up to about 4.4% today. That uptrend is concerning. Unemployment in the 4 to 5% range is still considered full employment, one of the Fed's dual mandates, so it's not yet at alarming levels. Either way, it looks like the decline in job openings is due to the Fed tightening cycle, not the release of ChatGPT. And this theory is borne out if you look at what's happened recently. The Fed began cutting rates again in summer 2024 from their peak of 5.3% down to just over 4% today. And since this rate cutting cycle began, job openings have ceased their steep decline. After a brief jump, they leveled off around 7.2 million. And no longer seem to be falling as dramatically as they were. What's still an open question is whether or not job openings will begin to grow again alongside the S&P 500 for as long as it does go up, or if AI-driven productivity truly has replaced the need for hiring as many workers as before, which would mean flatlined job openings going forward. It's important to note that monetary policy tends to work with a lag. It can take time for rate changes to permeate into the economy and show up in numbers like job openings. So if this is the case, we could see this trend reverse and job openings pick back up again in due time, especially if the Fed continues to cut rates. But recent disappointing jobs numbers have prompted concern that the Fed will not cut rates in December, a bearish outlook, both for jobs and for the stock market. But there's another possible explanation, and this is the scary movie scenario. The decline in job openings may have started with the Fed cutting rates, but in the time since, that may have shifted to a scenario where it actually is feasible for AI to replace a significant number of jobs. Companies have begun to seek out laborless profit in order to fuel soaring profits without having to go on a hiring spree. In this scenario, even if the Fed does continue to cut rates, and even if the stock market continues to ride high on AI innovation and productivity, that may not translate into a resurgence of job openings. At Capital.com, we'll keep you posted on what's going on with the labor market and how it could impact the broader economy and stock market. Hit like and subscribe to stay tuned. Thanks for watching.